UBS thinks that corporate earnings will continue to support U.S. stocks, and it projects that the S&P 500 will reach 6,400 in a year's time, substantially up from the current level. Let's get more from Pierre Ouimet, Head Investment Strategist at UBS Canada. Pierre, always great to see you. So your thesis here is that U.S. corporate profits are okay, and you generally think they'll remain that way?
Well, the rate of growth has slowed somewhat, but even if the U.S. economy will slow, therefore the rate of growth in profits are going to slow. But we're not looking at a profits recession. And if you take a 12-month kind of outlook on the market, we think the market can gradually move higher from here. I mean, 6,400 from where we are right now is not a major move. I mean, it's somewhat attractive, but compared to what we've last seen over the last 3 years, it's more reasonable. Let's put it that way. So we see margins kind of holding in and profitability being okay in the U.S., unless, of course, we go into a recession, which was not our base case.
It's not your base case, I'm sure you would concede, though we don't know the full damage from the trade war yet.
Well, there will be a slowdown in the U.S. economy. We've already factored that into the equation. So, that's going to happen. Definitely the U.S. economy will probably slow below a 2% pace, but inflation is going to pick up as well. But that's going to be somewhat temporary as well. And we think there's going to be rate relief sometime in probably the second half and the early part of next year. We think we'll see 100 basis points of cut in Fed funds rate, and that's going to provide relief to the economy. And then this whole issue about deregulation. And of course, once you get the tariff issue behind you, I mean, a lot of that uncertainty kind of dissipates. And that should be favorable for the investment climate in general. So we're going through kind of this uncertainty and this transition right now, but it's not going to be the end of the world, and eventually we'll come out of it. And the policies being put in place now will be favorable for growth going forward.
The S&P 500 is around 6,000 right now. You see it getting to 6,400 in a year. And then for the TSX, you see it getting to 28,000, which would be a gain of about 1,500 from the current level for the composite.
Yeah, again, that's not much of a reach. We don't see a lot of earnings growth here over the short term, but definitely over the mid and longer term. Definitely we like the Canadian market because of its commodity exposure, because we like commodities in general. Anything from agricultural commodities to metals, including gold. Energy, of course, is subject to speculation here over the short term, but we think natural gas, for example, is a great place to be. The outlook for natural gas for Canadian producers is quite good. So that's going to help the Canadian market in general. And I'll go with the shift away from U.S. equities or U.S. dollar-based assets towards international has benefited Canada so far this year. It's benefited all the other markets as well. But I think Canada will continue to benefit from that trend.
You see some key transformational sectors for investors here, or opportunities for transformational innovation. AI, power and resources, and this last one I found intriguing, the whole effort to increase the lifespan of people. Where will that offer opportunities, Pierre?
Well, it's the aging of the population. Anything that's related to healthcare in general is going to be, or services provided to the elderly as well, will be a net benefit. And so I think that's an area where there's some opportunity. Actually, healthcare stocks are relatively cheap, abundantly cheap relative to the rest of the market. I guess AI would be at the other end of the spectrum, or technology and robotics. I think that whole trend is just going to continue. It's going to move away from hardware towards software, and it's going to evolve in that direction. But clearly, there's going to be a lot of investment in there and a lot of potentiality as well. So those are two areas we like a lot. Even in a market that doesn't offer overall big returns, there's always some opportunities, pockets of opportunities within that market. So those are two areas we like for sure.
In power and electricity generation, vast amounts of nat gas capacity have been installed, and Tourmaline Oil is one stock you favour in Canada, a major gas producer.
Yeah, it's we've had it for a while in the portfolio, and Tourmaline and ARC as well, which are two favorite natural gas stocks. They're mostly involved in the Montney Basin, which is kind of a huge super natural gas basin here in Canada, which is just getting started. Really, it's compared to some of the more mature basins in the U.S. And there's this opportunity, of course, on the LNG side for exports, not only Shell Canada or potential expansion there, but other projects as well. And that's going to move gas out of the Western Canadian Sedimentary Basin. And it's right now, naturally, gas prices in Canada are at a discount to U.S. or NYMEX prices. And we think that discount is going to gradually erode as well. So it is not only a volume question, it's a pricing question as well, and particularly domestic prices. And I think natural gas will be a great transition fuel to cleaner energy going forward. So, Tourmaline and ARC, both of them are quite attractive.
One name you also favour is Nutrien. It's had a boost lately on speculation that Iranian exports of fertilizer-related commodities will be restricted.
Well, the stock's had a nice move. I wouldn't necessarily pile into it right now, but clearly it's had a nice move. The contract with the Chinese and Indian was quite favorable at a higher price. And the volumes will be steady going forward. It looks like look at the planting in the U.S., for example, it's going well. All of the major agricultural commodities seem to be headed in the right direction. So, and they had this large retail base as well, which is kind of the foundation of the company to a large extent. So it's not only a wholesale provider of fertilizer, but it's also in the retail segment. And it's from that perspective, it's well positioned. It's got a 3.5 or 3.7% yield on it, which is not bad for a resource company. So we like it longer term. You can be picky and maybe hope for a better entry point, but I think it's one you should have on your radar.